95% of traders lose their money. You've probably heard this statistic 100 times, but here's the question nobody asks. Why? Is it because their strategy was weak? Was it bad timing? Or is there something far more hidden? Something that quietly pulls them into failure without them even realizing it. Now think about this. The market is the same for everyone. The same charts, the same candles, the same buy and sell buttons. If that's true, then why do 95% collapse while only 5% survive? There's a mystery here. A silent force that wipes out traders again and again. And no, it's not what you think. It's not just about picking the wrong stock or missing the right entry. It's deeper. Much deeper. In fact, most traders don't blow their accounts because of the market. They blow it because of something inside them. Something invisible. That hidden layer, the silent trap, is exactly what we're going to break down in this video. Over the next few minutes, I'll reveal the unseen mistakes that quietly drain accounts to zero, the psychological traps that almost every beginner falls into, and most importantly, the roadmap, the exact steps, that can move you from the 95% who fail into the 5% who win. But before we go deeper, let me ask you this. Have you ever placed a trade that felt perfect, only to watch it instantly turn against you? Have you ever told yourself, just one more trade, I'll recover it all, and then watched your account sink even further? If you nodded, even silently, you're not alone. Every single trader has walked through that storm. Some never return, but a rare few find the way out. And that's exactly what this video is about. Not theory. Not random tips. But the real reasons why accounts get blown up, and how you can escape that cycle forever. Because once you see what's really happening beneath the surface, you'll realize, trading failure isn't an accident, it's a pattern. And once you recognize the pattern, you can break it. So stay with me, because by the end of this video, you'll never look at your trading the same way again. When people hear 95% of traders fail, it almost sounds like a myth, like just another scary statistic to keep beginners away from the markets. But here's the truth, that number is painfully real. It represents the vast majority of people who enter trading with hope, energy, and ambition, only to leave broken, frustrated, and empty-handed. So what exactly makes up this 95%? It's not that these people aren't smart. Many of them are intelligent, hard-working, even well-educated. The reason they fail isn't a lack of brains, it's a lack of structure, discipline, and understanding of how the market really works. The first common mistake is trading without a plan. Most beginners jump into the market with excitement, but no blueprint. They don't know their risk tolerance, they don't have defined entry or exit rules, and they certainly don't have a tested strategy. Trading without a plan is like trying to sail across the ocean without a map. You might get lucky for a while, but eventually, the storm hits and you're lost. The second mistake is over-leverage and greed. New traders see leverage as a shortcut to riches. They think, if I can double my account with one big trade, why waste time on small gains? The problem is leverage is a double-edged sword. It can amplify your profits, but it can also destroy your account in seconds. One wrong move, and months of progress disappear overnight. The third mistake is jumping from one strategy to another. This is what traders call system hopping. Instead of mastering one method, beginners constantly chase the next best thing. An indicator they saw on YouTube, a new setup they read about in a forum, a secret method from a signal group. But here's the reality. No strategy works if you don't give it consistency and discipline. Every trader comes to the market with the same dream: freedom, profit, control over their own destiny. But most leave with the same scars, an empty account and the haunting thought, where did it all go wrong? The truth is, it usually doesn't start with bad strategies, it starts with bad psychology. The mind is the battlefield, and if you lose there, you've already lost in the charts. Does this sound familiar? For some of you watching, it might even hit too close to home. Because Alex's story isn't rare, it's the story of almost every trader at some point. That feeling of being on top of the world one day, and the crushing pain of losing it all the next. And this is where the harsh truth sets in. Trading failure is not random. It doesn't happen by chance, and it's not because the market is rigged. It happens because traders repeat the same patterns. No plan, too much risk, chasing quick wins, ignoring discipline. The market doesn't destroy them, they destroy themselves. But here's the good news: if failure has patterns, then success also has patterns. And the 5%, the elite few who actually make it, aren't magical, lucky, or superhuman. They simply do the opposite of what the 95% do. They build structure where others improvise. They manage risk where others gamble. They stay consistent where others chase shortcuts. This brings us to the real question: what separates the 95% who fail from the 5% who win? To answer that, we need to go deeper into psychology, the invisible force that shapes every trading decision. Every trader comes to the market with the same dream: freedom, profit, control over their own destiny. But most leave with the same scars, an empty account and the haunting thought, where did it all go wrong? The truth is, it usually doesn't start with bad strategies, it starts with bad psychology. The mind is the battlefield, and if you lose there, you've already lost in the charts. The first and most common trap is FOMO, the fear of missing out. You see a candle shooting up, and your heart starts racing. Your mind whispers, if I don't enter now, I'll miss the move of a lifetime. And so you jump in late, right at the peak, only to watch the price reverse. Take Emma, a beginner trader who once skipped her setup rules because Bitcoin was spiking. She bought at the top, convinced it would go higher. Within minutes, the candle turned red, and half her account vanished. The market didn't punish her trade, it punished her fear. Then comes the poison of revenge trading. You take a loss, you feel the sting, and suddenly it's not about strategy anymore, it's about ego. You think, I'll win it back. I'll show the market who's boss. But the market doesn't care. Take the story of Raj, who lost $200 on a bad setup. Angry, he doubled his position on the next trade without even analyzing the chart. The loss grew into $800. By the end of the day, his account was gone. Revenge turned one mistake into destruction. The third trap is overconfidence. This one is more dangerous because it hides behind success. Imagine a trader named Lisa who strung together 5 winning trades in a row. She felt invincible, so she increased her risk. Why not? After all, she believed she understood the market now. The next trade. A sharp reversal. Not only did it wipe her profits, but it also wiped half her capital. Overconfidence blinds traders into thinking they're bulletproof, until the market proves otherwise. The fourth silent killer is impatience. Trading is a waiting game, but most traders can't sit still. They crave action, they crave movement, and when nothing is happening, they force trades. David's story illustrates this perfectly. He spent 3 hours watching charts but saw no clean setups. Bored, he entered a random trade just to be in the market. Within 15 minutes, his stop-loss was hit. The truth is, in trading, doing nothing is sometimes the most profitable move, but impatience won't let most traders see that. And then there's lack of discipline. This is the just this one trade syndrome. You tell yourself, I know I shouldn't risk this much, but just this once. And slowly, just once, becomes a habit. Mark, a disciplined trader for months, had strict rules. Never risk more than 2% of his account. But one day, he broke his own rule, thinking it was a sure win. That single moment of weakness cost him 3 months of steady growth. Discipline is built slowly but destroyed instantly. Put all of these together: FOMO, revenge, overconfidence, impatience, and lack of discipline, and you get the perfect recipe for disaster. Each mistake may feel small in the moment, but combined, they become the silent killers of trading accounts. It's not the market that blows accounts, it's the trader's own psychology eating away from within. What makes this even more dangerous is how invisible it feels while it's happening. Traders rarely realize they're trapped until it's too late. They blame the chart, the broker, or the news, when in reality, it was their emotions steering the wheel. The candlesticks aren't the enemy, the mind is. And yet, there's a powerful truth hidden here. If psychology is what destroys accounts, it also means psychology can be what saves them. The same mind that falls into fear and greed can also be trained to follow rules, to stay patient, to control impulses. That's the difference between the 95% who fail and the 5% who win. So here's the transition. Failure in trading is not random, it's patterned, and those patterns are psychological. But if the mind is where 95% lose, then the mind is also where 5% survive. Which raises the question, what do the survivors do differently? How do they think, act, and trade in ways that separate them from the crowd? Here's the secret nobody likes to admit. The market doesn't reward excitement, it rewards discipline. The 95% who fail are gamblers in disguise. They chase thrill, adrenaline, and the quick win. But the 5% who win consistently, they flip the script. For them, the game isn't about hunting profits, it's about managing risk. Think about that for a second. Risk first, profit second. It sounds backwards, but that's exactly why it works. When others dream of doubling accounts overnight, the top 5% are asking, how do I make sure I survive tomorrow? The winning traders treat capital like oxygen. Without it, the game ends. That's why every decision starts with one simple question: what can I afford to lose? If the answer feels heavy, they reduce position size. They don't fight the market with ego. They don't bet the farm. Instead, they preserve energy, like a marathon runner pacing themselves for the long haul. This mindset shift, from chasing gains to protecting capital, is what builds consistency brick by brick. Consistency is boring, and that's exactly the point. While the majority jump from strategy to strategy, desperate for the holy grail, the 5% build routines so predictable they look dull to outsiders. Same setup, same risk, same rules. Day after day. They don't chase the market, they wait for it. They know excitement is poison, because excitement clouds judgment. So they embrace boredom. Why? Because boredom is stable. And stability is where compounding begins. One of the biggest differences is how they view trading itself. For losers, trading is a casino. For winners, trading is a business. And businesses don't survive on gut feelings. They survive on systems, records, and rules. That's why the top traders journal every single trade: wins, losses, emotions, mistakes. They know memory is deceptive, but records never lie. A trading journal is their black box recorder, capturing every flight, every crash, every lesson. Over time, patterns emerge. Weaknesses reveal themselves. And through this process, they refine, not repeat. Let me tell you a short case study. There was a trader who started with just $3,000. At first, he blew half of it in a single week. Not because his strategy was broken, but because his mindset was. He was chasing signals on Twitter, copying strangers, and trading without rules. Then he did something different. He stopped trading for an entire month and focused on one thing: building a journal. Every setup was tested on paper, every outcome recorded. When he returned to the market, he had a blueprint. Within 6 months, he wasn't just profitable, he was consistent. Not because the market changed, but because he did. The survivors understand this universal law: transformation comes before profits. You don't become a winning trader by finding the perfect strategy. You become one by transforming how you think, how you react, how you prepare. The charts don't change, the trader does. That's why the 5% spend more time studying themselves than the market. They know the biggest battle isn't with the candlesticks, it's with their own psychology. Another key trait is patience. While the 95% force trades, the 5% let the market come to them. They can sit out for hours, days, even weeks if conditions aren't right. To the outsider, it looks lazy. To them, it's discipline. Because they know one high-quality trade is worth more than 10 impulsive ones. This patience is what protects them from FOMO, from overtrading, from emotional traps. They aren't hunters chasing prey, they're fishermen waiting for the tide. They also understand that success isn't about a single trade, it's about the next 1,000. That's why they think in probabilities, not guarantees. When a trade wins, they don't celebrate like they've made it. When a trade loses, they don't spiral into revenge mode. They see both outcomes as part of the process. Wins and losses are simply data points. The business moves forward, one measured step at a time. This mindset, business over gambling, risk before profit, consistency over excitement, is what separates the 5% from everyone else. They still lose trades, they still have drawdowns, they still feel emotions. But the difference is how they respond. Where others break, they adapt. Where others quit, they persist. They're not searching for certainty, they're managing uncertainty with rules. That's why they last. And here's the biggest revelation. Becoming part of the 5% is not about luck, it's about transformation. It's about rewiring how you think, act, and respond to pressure. It's about shifting your identity from gambler to business owner. From reckless to disciplined. From thrill seeker to professional. The market doesn't choose winners at random. It rewards the ones who transform. The question is, are you willing to go through that transformation? The very first action is deceptively simple. Write down your rules. Not in your head, not in vague memory. On paper. Rules about your risk, your entry, your exit, your maximum trades per day. Why? Because rules only protect you when they're visible. When you see them written in front of you, they stop being ideas and start being commitments. Without rules, you're gambling. With rules, you're building a system. This is the foundation. Next, start small. Either with a demo account or with money so small it won't break you emotionally. Too many traders think they'll take it seriously only when they fund big accounts. But that's backwards. Professional pilots learn on simulators. Athletes train in practice matches. Traders should do the same. Your early goal isn't to make money, it's to prove you can follow your own rules with discipline. Mastery always begins with small stakes. Third, shift your focus from money to consistency. Most traders blow accounts because they're desperate to double their capital in weeks. That hunger blinds them to discipline. Instead, focus on being consistent, executing your edge, following your plan, repeating your process. One consistent month beats one lucky trade. And here's the truth. Once you can trade consistently with $100, scaling to $10,000 is just numbers. Consistency is the real currency. Fourth, avoid comparison. The fastest way to sabotage your growth is by measuring yourself against someone else's highlight reel. Maybe you see another trader post massive profits on Twitter or YouTube. What you don't see are their hidden losses, their sleepless nights, their blown accounts from years past. Your journey is yours. Every comparison distracts you from your process. The 5% win not because they're faster, but because they stay on their own lane. Fifth, build a feedback loop. The process is simple. Trade, review, improve. After every session, go back to your journal. Ask, did I follow my rules? Where did I slip? What worked? What didn't? This review is where growth happens. Imagine if every week you eliminated just one mistake. In 3 months, you'd be a different trader. In a year, you'd be unrecognizable. Feedback isn't punishment, it's the accelerator of mastery. Now notice how all these steps connect. Rules give you structure. Small size protects your capital. Consistency trains your discipline. Avoiding comparison keeps your focus clean. The feedback loop accelerates growth. Each step by itself matters, but together, they compound. Over time, you don't just follow rules, you become the kind of person who naturally acts with discipline. And that transformation is the invisible difference between the 95% and the 5%. Picture this, a trader sits in front of a glowing chart, chaos spinning in the background. But on their desk is a journal. In that journal are rules, written clearly. A small trade is placed, not to get rich, but to build consistency. Around them, noise and pressure exist, but they don't compare, they don't chase. Every day, they repeat, Trade, review, improve. Slowly, the storm fades. That's what action looks like. That's how the cycle is broken. So if you take nothing else from this video, take this: action beats intention. The roadmap only works if you walk it. Start with rules, start small, focus on consistency, ignore comparison, build your feedback loop. Do it day after day. And here's the most important lesson: the market doesn't demand perfection. It demands discipline. We started this journey with one big question: why do 95% of traders fail while only 5% survive? And now, you've seen the truth. It's not about luck. It's not about secret indicators. It's not even about finding the perfect strategy. The dividing line isn't on the chart, it's inside the trader. That's where the battle is won or lost. Most traders blow their accounts because they repeat the same invisible mistakes: chasing trades, risking too much, acting out of fear or greed. And that's why the failure rate stays so high. The 95% don't fail because the market is impossible. They fail because they never learn how to master themselves. They let emotions write the rules. But the 5%, they think differently. They treat trading like a craft, not a gamble. They choose discipline over excitement, patience over FOMO, consistency over chaos. And here's the part most people don't realize: the 5% aren't superhuman. They're not smarter, luckier, or born with some special gift. They're ordinary traders, who simply choose to act with consistency. So hear me clearly: you don't need to be extraordinary to win. You don't need the fastest computer, the fanciest charts, or the most complex strategy. What you need is consistency. The power to stick to your rules when others break them. The patience to wait for your setup when others chase. The humility to learn from mistakes when others repeat them. That's what separates the winners from the rest. Imagine this: the tornado is still spinning. 95% of traders are caught in the storm, spinning helplessly, losing again and again. But you step out of the storm. You stand in the calm. You become part of the 5% who don't just survive, but grow. Every choice you make pulls you closer to that side. And it begins not tomorrow, not someday, but today. So my challenge for you is simple: don't let this just be another video you watch and forget. Take one action: write your rules, start your journal, set your risk. Do something today that moves you out of the 95% trap. Because the difference between failure and success isn't knowledge, it's action. And as we close, remember the words on this thumbnail: 95% fail. That's reality. But it doesn't have to be your reality. Don't be in the 95%. Choose to be in the 5% that win. Thank you for giving me your time, your attention, and your trust. If this video gave you clarity, if it sparked something inside you, then join this journey. Subscribe to the channel, hit like, and share your thoughts in the comments below. Because together, we're building a community of traders who refuse to be part of the statistic.